Companies generate return on capital, but they've also got a cost of capital. And that cost of capital is in the form of equity and in the form of debt. If a company's cost of debt and cost of equity combined, if that is, say, 8 or 9%, then you want to be earning well above that in order to be generating shareholder value.
Hello everyone, welcome to our Twitter live. A quick reminder, if you haven't already, to follow the eToro AU Twitter page for the latest on markets, and head over to our YouTube channel as well for a wealth of content there. Today I'm chatting to Greg Canavan. He is the editorial director of Fat Tail Investment Research and editor of the flagship investment letter Fat Tail Investment Advisory. Greg is a well-known name across the Australian financial media landscape and is also a successful author as well. And today we're going to be looking at the psychology of investing, valuation techniques, and also how to throw in some charting into the mix as well. So it's going to be a great chat, going to cover plenty of areas of the market. But before we get started, Greg, thanks for joining us. How are you doing today?
I'm well, Josh. Thanks for inviting me, mate. It sounds like an interesting conversation and looking forward to getting into it.
Absolutely. Well, look, we've had a bit of a mixed couple of weeks with markets. A lot of good news has sort of come through. Firstly, coming from China, really, and we've obviously had markets react pretty well to that first cut from the Fed overnight. Of course, we've had some geopolitical tensions sort of throw a bit of volatility into markets. But I want to dive first into China, Greg. You've written a fair bit about it over the years, and I want to get your take on that latest stimulus rollout. Obviously, it's been very well received by anything linked to China. So if we look at iron ore miners, etc., they've all done very, very well. I think Rio Tinto last week had its best week for almost 10 years. But I want to sort of find out, as I say, what your take is on that stimulus and what you think is next.
Well, I think just to put the sort of the China commentary in context, for many years I've been quite bearish on China, just in terms of its huge property boom and bubble that it went through, and it was trying to control the bust of that property boom for many years. But the equity market in China over the past couple of years has declined 50%. And the sentiment towards China was so negative. I think it was one of the most popular trades for global fund managers was to be short China. So around May this year, I actually recommended a couple of China ETFs for my subscribers, just on the basis of it being, can it get much worse? We've got very cheap equity markets. We've got very negative sentiment. And my sort of as we'll get into when we talk about the psychology, I look at the psychology of markets, and I think when it can't get much worse and you've got very well-priced asset markets in terms of the valuations, then it's time to take a position. So I got completely lucky. China was in a pretty sort of deflationary, with very low confidence, not looking particularly good. But the stimulus measures that come through last week were a major catalyst, and I think a major catalyst for a number of things. So a major catalyst for a shift in Australia, a shift out of banks and into resources. I think more globally, a shift out of US tech and back into China and the commodity story. I think it is a pretty comprehensive bunch of measures that the Chinese government has come up with. I did speak to a China specialist this morning. I interviewed Louis Vincent Gave of GavCal, and that they are China specialists. They've been involved in China for many, many years. He did make the comment, though, that while he was bullish on China, don't expect this to be another iron ore infrastructure property-led boom. He said what they're trying to do is absorb existing supply of property rather than get new property built. So there is a bit of nuance to it. I don't think it's the same as those past stimulus packages where the automatic response has been to go on by BHP, Rio and Fortescue. But he did mention that if you want to get access to it, go into China itself and buy the Chinese shares. And there's a couple of ETFs on the Aussie market that give you that exposure.
Yeah. Well, it was interesting that we actually got that big rollout, wasn't it? Because we had so many false starts, it felt like. We had a couple of, rollouts. We had a couple of measures over time, which sort of boosted assets in the short term, as you mentioned, those iron ore miners. But that was sort of the one that sort of gave us that lift. And as you say, for a long, long time. It felt that we were never really going to get that sort of, real kickstart. But, as you say, with valuation so low, sentiment so poor as well, I guess it was only a matter of time. I mentioned at the start of the webinar, you are a successful author. You have a book, You, Your Brain, and the Stock Market, and in there you talk about the value of ignorance, and that was something that I thought was pretty interesting. So I wanted to get your view on what you mean by that, and how you think that mindset helps investors avoid sort of biases and ultimately make clearer decisions in the market.
Yeah, I think that was probably one of the most enjoyable parts of writing that book, was really delving into that stuff. And I think what I mean by the value of ignorance is the world is driven by narratives, the world is driven by stories, and stock markets are obviously driven by these stories as well. And just to, the recent example is the Mag 7. Everyone believes that the Mag 7, that's where all the money's going. Passive investors, all the money's going into those stocks. And when you believe a story too much, then you can get sucked into that narrative and you lose any ability to think rationally. And especially when we're talking about markets that go into bubbles, Tesla is another good example of a narrative story-driven stock. If you believe that story too much, if your biases are so powerful that you just forget about thinking and you think you know everything and you're confident, overconfident, that can lead to huge amounts of problems as an investor. So one of the things that I wrote about was that you always need to admit that you don't know everything about markets. And it seems like an obvious thing to say, but once you get locked into a story and the stock price is going up and you're making money, then you tend to lose a bit of the rational ability to think about it from an outsider's perspective. You're locked in, you're believing the story, and not much can change the way you think. So by having this default mode of I'm ignorant, I don't know everything, it allows you the mental flexibility to change your mind. And I think that's one of the most powerful things for investors. I would say traders more so, is that ability to change your mind very, very quickly. But if you are locked into a story, locked into a narrative, it makes it very hard to change your mind. So I think that's where the power of ignorance comes from. If you can admit your ignorance, admit you don't know everything, and try to control your ego in that respect, it will make you a much better investor and a much better trader.
Yeah, it's such a good point, I think, as well, because I think especially when we look at a company that's done so well, the viewpoint of it, that sort of fear of missing out, right, on that sort of future rally or whatever that might be. And if it is, as you say, something like Tesla, which had such a great run, you had such a charismatic leader in Elon Musk, it's hard to maybe not sort of believe in everything he's sort of saying, and to try and take a step back and as you say, try and take a sort of a broader look at it rather than just sort of that one way approach. And I guess with that, do you have any sort of maybe practical tips or anything like that, how investors can sort of recognize and then maybe overcome some of their biases in the market, right? Because you say, we talk about the Magnificent Seven. It was hard to sort of maybe see investors rotating away from something like Nvidia, especially when we are in sort of what is the midst of this sort of AI boom. How can we do that? How can investors sort of recognize when they are maybe sort of becoming very biased towards a stock, and then trying to, as you say, have that ignorance?
Well, I think you're probably talking about a couple of different things there. So the first thing that I think investors need to do is to really understand who they are as an investor. And often when people first go into markets, or they might be a little bit of inexperienced, they want to chase every sort of thing that's moving, because they think, oh, that's the thing I've got to jump onto. That's the thing I've got to jump onto. But at the end of the day, you've got to understand who you are as an investor and what type of investor you are, because you've got to be able to endure some ups and downs and not jump at shadows at every point. So that's the first thing. And what that takes sometimes is, it might take a tough lesson in a big loss, and then it might force a bit of introspection and you wondering how you made that mistake and how you got to that point. So I'd really sort of suggest that you need to think about who you are as an investor and examine the things that drive you. Are you someone that gets sucked into these narratives? Are you someone that suffers from FOMO? And any type of weakness that you have, the market will find it and punish you for it. So you really need to find out what those weaknesses are and try to compensate for it. The other question I think you asked was about, when to get out of these narrative-driven stories. And I think for me, there's two aspects of it. You need to understand valuations, and you need to have a process for understanding what an overvalued and an undervalued stock is. I lay it on top of that. Charting is a really useful tool. So Nvidia, for example, everyone's been saying it's been overvalued for a long time, but the valuation is catching up to the share price because it's generating so much in the way of revenues and earnings. So charts are sometimes a good tool to keep you in a stock, even though it might be overvalued. So if a stock is trending higher, then sometimes you should just stick with it. As it gets higher, you might want to reduce your risk and sell down a little bit. So you're maintaining a 5% position in your portfolio or a 10% or whatever it might be, but don't let it get to a point where it's really dominating your portfolio. You might want to take profits as it heads higher. The one thing then from the charting perspective is to look at, is this on the cusp of a change in trend? And I would argue that a company like Nvidia might be at risk of that now. You've seen a big correction happen over the past couple of months. It's bounced back to try to make new highs. It hasn't been able to do that. And it's starting to move in that way that when you look at charts a lot, you start to think, okay, is this, for a charting term, is this distribution taking place? Are the long-term owners selling out to the latecomers trying to jump on board the Nvidia sort of story? So there's all things like that come together to try to give you a sense of when is this trend over? And going back to what we spoke at the start, this reinforces that in that now I think global capital says, okay, commodities have been unloved for years. Commodities were a short. China was a short. Everyone was long Nvidia and tech. Are we going to start to see a rotation out of that? So you take all these things into account, and it's just about probabilities. There's no certainties in markets. You work out where the high probability trade is, and you take a bet on that. You work out where the low probability trade is, and you move away from that. And I think with Nvidia's massive run over the past couple of years, it's a low probability trade now in terms of making the same amount of money that you would have a couple of years ago.
Yeah, and what a run it has had as well. I was actually reading a story the other day that was saying that the struggle they actually have at the moment is actually trying to keep staff because they've actually made so many of their staff members millionaires through stock options and things like that in the US. So trying to keep some of the most talented engineers is becoming a bit of a struggle at the moment. So I mean, that's I guess a good problem to have in the sense, but you don't want to lose some of your best. You mentioned in there though, Greg, a little bit about sort of valuations, and also I think it's really important to talk about the importance of understanding the companies you own. We covered a lot here at eToro, and it goes back to Warren Buffett's philosophy of sort of not owning a stock if you don't understand how it makes its money. For you, when you're sort of evaluating a company's fundamentals, again, it can be short-term, it can be long-term, what are some of the key financial metrics that stand out to you that help you spot sort of growth opportunities? And then also, why do you use them?
Let's see. So I guess my starting point would be to try to work out what a company's return on tangible capital is. So I'll look at a balance sheet, and the main adjustments I'll make are things like tax assets or liabilities. I'll remove goodwill. So I'm trying to work out what the tangible capital on that balance sheet, what is that producing in the way of a profit? And then you work out what the profitability is. So let's say, as a general rule of thumb, any company with a return on tangible capital of over, say, 15 or 20%, that means you're looking at a pretty decent business there. And if it's got the ability to do that over and over and over, that's something that I would look closer at and do a valuation of. The reason why I look at that, companies generate return on capital, but they've also got a cost of capital, and that cost of capital is in the form of equity and in the form of debt. So if a company's cost of debt and cost of equity combined, if that is, say, 8 or 9%, then you want to be earning well above that in order to be generating shareholder value. Mm-hmm. So if I look at a company and its return on tangible capital is 5, 6, 7%, I don't even want to invest in it because it's longer term that's going to compound to lower returns for shareholders. It's going to destroy value for shareholders. Whereas a company with a 20% return on tangible capital, I can be pretty sure that is going to generate wealth for shareholders. In terms of looking to see whether there's growth or not, one way of doing it is to look at the dividend payout ratio. I don't think enough people do that. I think if a company is a high dividend payout ratio company, that means there's a lack of growth prospects internally. So it's not necessarily a growth company. But if there's a company that's reinvesting at least 50% of its profits back into its business, then that should be a higher value company, given that it's reinvesting at those higher rates of return. So that's something I look at. But more broadly, it's all about the valuation. You can have a company with a really high return on capital. It can have a really good growth prospects. But if the market's already priced that in, for me, it's not worth buying. You've got to try and find those anomalies where there's good businesses that have been knocked around in the short term for some reason, and that's the opportunity to buy into them.
Yeah, so then that's a good point. We'll move into that then to look at sort of how we're going to see if a stock is undervalued. And we spoke about China right at the start, and again, maybe saw some sort of value there given how much worse could this get, given that the sentiment was so bad. So broadly, how are we going to assess if a stock is undervalued, and what role does valuation really play in your investment decisions?
For my process, valuation is probably the most important thing. So if I'm looking at the percentage that I put on valuation versus charts, for example, I'd probably say 70% of my time, effort, and conviction comes from the valuation, and 30% from the charts. And the valuation for me, it's like a discounted cash flow analysis. I'll look for free cash flows, net operating profit after tax, to try and work out what the return on tangible capital is, and then I'll put it into my model and I'll get a valuation on that. So for me, valuation is really important. I want to be buying stocks that are unloved, cheap, and then I'll want to see how the chart's looking. If the chart's in a nasty downtrend and the valuation's really compelling, I might want to take a very small position in that, knowing that it could probably fall further because the chart tells you when something is trending lower, and when something's trending lower, it can keep trending lower until it stops. So you don't want to go all in when a stock is trending lower, even though it might be fundamentally attractive on valuations. And then if that trend starts to turn around and it tells the market tells you you're right, or tells you that the thesis is playing out, then you can add to it and increase your exposure. But just one other thing, the most trouble I've ever got into buying into stocks is when they've had too much debt. And that's not really a revelation. Most people have had that same problem. For example, Fletcher Building. I bought into that last year when I thought the cyclical downswing had already damaged the share price enough. So I thought, okay, we're buying at a cyclical low point here. And it's gone on to fall another probably 30% since then. I've sort of bought into it as it's gone down, just to sort of increase the holdings. So I do think it's a company that will reward investors once the cycle turns. But the fact that it's had a lot of debt on its balance sheet, I probably didn't put enough weighting on that. Now it's done a capital raising at the bottom of the cycle, which is horrible for capital management perspective. The only saving grace is that existing shareholders get to participate in that capital raising. But often highly indebted companies, we saw it with Min Resources just recently, the market completely dumped that stock. I mean, it's bounced back in the last week or so, but the market completely panicked, knowing that its debt was too big, and the fact that iron ore was falling and lithium was falling, and the market I think it went from $80 to $30 in a matter of months. So you've got to be careful of not getting too enthusiastic about companies that have got stretched balance sheets. That's what I would say.
Yeah, and it was interesting. We had a quick look at some of the cruise liners just recently as well, and wow, don't they have some debt on their balance sheet? But if we look at some of them, they've performed quite well recently because you've got cruising coming back in a big way. You've got
leverage works both ways, doesn't it?
Yeah, exactly. So look, I think it was one of those where if they can pay their debt down and can sort of continue to move forward with that, then again, investors are forward looking on the view that balance sheet is sort of going to improve. And just a quick reminder as well to anyone listening, head over to the eToro Academy to have a look at sort of breaking down fundamentals, charting, and those types of things, and how to sort of understand valuation a little bit more. You mentioned there as well, we talked about charting, so let's sort of jump into that side of it. Combining, I think, technical analysis and fundamental analysis is sort of really important. But how do you use technical analysis, as you say, because your valuation is 70%? How do you then combine the charting to sort of confirm or then challenge those investment ideas that you might have?
Yeah, I think it's just a good overlay, right? To sort of, you come up with a stock idea. One of the first things I do is I look at the chart and I think, okay, what's the chart telling me? And I guess what's a really good way to think about charts is that they're a bit of a window into the psychology of the market. So whether that's a broad indice or whether it's a specific stock chart, they tell a story, and you can match that story up by understanding the fundamentals of the business, by understanding what the business does, whether it's cyclical, whether it's financial services, whether the market likes it, whether the market doesn't. You get a sense of the story of the stock in the chart. So a perfect situation is what I want to see is a stock that might have been in some trouble, it might have sold off, and it's finding some support in a certain area. There's clearly investors that are coming in that are buying at a certain level and then starting to lift away from that level and starting to move into another uptrend. They're the sort of sweet spots. I guess the main thing is that you want to not buy in too heavily or not get too bullish on a stock that is trending in a pretty strong manner.
Yeah.
The one exception to that rule is when there is general panic in the market. That just tells me that there's an emotional situation in the market. It's not based on fundamentals. It's emotional panic. And I think that's when I would probably be a little bit more inclined to take positions in stocks that are in sharp downtrends, because it's the whole markets that sold off. When there's one stock in a downtrend and the rest of the market is heading higher, that's when you have to wonder about what's wrong with this company. Why isn't it moving along with the rest of the crowd? There's something clearly wrong there. I need to just wait and see how that turns out. But when the whole market is dumping and panicking, I think it makes sense from a contrarian perspective to step forward and say, I think there's value here. I'm gonna step up and take a position. So there's nuances like everything, but that's generally how I'd look at it.
Yeah, I think it's great to mention that sort of part about volatility, right? Because it looks like we might be getting into a period of the market where we might see a bit more sort of sustained volatility. And I think a great example of what you mentioned there in terms of that sort of down trade from a charting perspective and an emotional factor, we sort of saw it a couple of months ago when the carry trade sort of unwound from the Japanese yen, and the market, the S&P 500 fell by about 5%. A week later, it sort of rallied back up again, sort of 5%. So I think that fits to your point in saying sort of following that downtrend and really the fundamentals didn't change. Is that sort of the advice that you would probably give, is that in a situation where volatility is heightened, emotions play a bigger factor, is to sort of, if the fundamentals haven't changed, we look at the charts to sort of try and confirm a bias?
Yeah, and it is tricky because often charts will move ahead of fundamentals. So you have to be really conscious of the fact that markets are forward looking, and the fundamentals, what you're seeing in financial statements, are anywhere from 3 to 6 months behind. So markets look forward. So you do have to respect when there are major moves like that. But I think that the smartest thing to do is say, look, don't panic. Let's wait for confirmation that we've seen a change in trend. And 1 week of a sharp downtrend, sharp move down, is not really confirming anything. It's just one week. One thing that I do look at a lot when I look at the media, whether it's social media, whether it's the Fin Review, the headlines that you see, I just look for clues in those headlines. And one clue that we saw on social media during that sort of panic about Japan, I can't remember the guy's name. It was some guy went on CNBC in the US and he was pleading for emergency rate cuts based on 1 or 2 sharp down days. And I thought, okay, that's emotion, that's panic. So we shouldn't be getting involved with this. And one thing from an investor's point of view, and Buffett says it all the time, is our job as investors is to stay rational. And if you see the market being emotional, your job is to resist joining that. So if you're predisposed to being emotional, panicking when the market's panicking, just turn the screens off. Just walk away. You don't need to, because it does things to our brain chemistry. It fires up all the neurochemicals that make it very hard for us to stay rational. So I think one of the things that people can do when there is a lot of emotion in the market is to go out for a walk, just get away from the screens and breathe, and then come back and look at it from a rational perspective instead of from a panic perspective.
Yeah, absolutely. And as you say, the psychology factor of it plays such a big part in investing. And I think, even just opening up that portfolio, it's never nice to see when red happens, but let's be honest, it's a price of admission.
Always going to happen.
Yeah, it's the price of admission, right? And I think, as you say, taking a step back, taking a breath, going on a walk, and just sort of reminding yourself that all is okay in the world, I think that's kind of pretty important. I think one thing I'd like to sort of just maybe get your sort of maybe bit of tips on and your viewpoint on is maybe investors that are just sort of starting out, or those that have maybe started out and looking to sort of optimize their strategy, how they can go about sort of finding new opportunities, combining, as you say, the technical analysis side and combining the fundamental side, how you'd sort of piece all of that together. As I say, any practical sort of advice that you could give to those people that are looking to do that?
My practical advice would be to try and work out who you are as an investor. Are you a trend follower? Are you a trader? Are you a longer term investor? And often it takes a while to work that out. So if you're new to the market, I would just have a crack at whatever you think is interesting. And with that, when I say have a crack, not too much of a crack, because you'll probably lose some money. And once you lose money, that's the cost of the education of being in the market. You will start to learn, and that's the only way that you're going to learn is to be involved. And I've never been a fan of, I don't know if you guys do it, but I've never been a fan of trading dummy accounts where you've given 100,000 of pretend money and trading, because if you don't have money on the line, you're not learning anything. You're just trading digits. So I would say just get involved. Find out who you are as an investor. I'm a contrarian investor. I have always liked to go against the grain, and I just think that's the only way to really make money long term. I think if you're a trader, then you want to be trading short-term trends, and I just can't do that. I've never been good at that. So you need to work out what type of person you are as an investor, and if you feel like you don't have the knowledge and the ability to make that work for you, find someone in the market that you can follow, that can help you, whether it's a newsletter writer like myself, or whether it's someone, people like that you guys have on that help people hold their hands through certain markets. You just need to find someone that you trust, that can help you through certain periods, give you an education, help you understand who you are, how the markets work, where the opportunities are. But for me personally, I'm a contrarian. I look for out of favor opportunities that are good, deep value, and I'm happy to buy, and I'm happy to sit on them for longer term. Like, for example, I bought Origin Energy, Whitehaven Coal back in 2021, and I still have them in the portfolio. So once you find something when it's out of favor, don't be scared just to sit on it. You don't need to trade in and out of it. You don't need to take the profits quickly. If it still looks good, just stay in there. And that's me as an investor. Traders are different, but yeah, I'm not sure if that's answer your question, but that's
yeah. It's right though, isn't it? Right, if the fundamentals, don't change from when you originally bought in, if it's out of favor and the trend is still there, then yeah, exactly. There's no reason to sort of sell out of the position. And it was interesting what you mentioned about the virtual account, because we do have it, but you're very right in the sense that it is a great tool, right? You can go in, you can practice, you can sort of learn the way that the markets move, especially if you're sort of just starting out, but it doesn't sort of give you that emotional attachment. So I think the beauty of it is having it there, having a tool to sort of be able to move back to if you want to sort of hone a strategy, if you want to learn the markets a little bit more, but even just sort of starting out with a small amount of dollars, in a way that can allow you to sort of really bring your emotions in, because there is a big difference there. So I think that's sort of really important to know.
Yeah, absolutely. Yep.
Greg, look, thank you very much for joining us today. For more from you, head over to Fat Tail Investment Research, where they can sort of follow you guys.
Yeah, that's right. Fat Tail Daily. We've got a free daily email that goes out. I don't contribute to that one too often, but you'll find a lot of free stuff there that you can check out and see. As I said, who you like, what type of investments that interest you, and I write a weekly newsletter called Fat Tail Investment Research, so you can check that out as well.
Superb, Greg. Thank you very much, and thanks everyone for watching. A reminder to follow eToro on Twitter. We do these every single month to give you up-to-date content. Again, head over to YouTube as well. Plenty of videos on there. The eToro Academy, as I mentioned earlier, has plenty of guides. So if you're not too sure about what we covered today, head there or pop us a question in the comments. If there's anything you're not sure of, we can help you out. But thanks everyone for watching, and we'll see you next time.